Welcome to Furniture Industry News. Today is Friday, August 23rd, 2024. Let's dive into the latest happenings in the furniture industry. This week, a federal judge in Texas set aside the FTC's nationwide ban on non-compete agreements. The ruling came from Judge Ada Brown, who stated that the FTC overstepped its authority and lacked the substantive rulemaking power to enforce such a ban. The initial ban was set to go into effect on September 4th, but has now been halted. The FTC argues that non-compete agreements are detrimental to workers and the economy, stating that eliminating them could lead to higher wages, reduced healthcare costs, and more business formation. In fact, 1 in 5 U.S. workers, or about 30 million people, are bound by such agreements. The agency had received a strong public response in favor of the ban, with 25,000 out of 26,000 comments supporting it. However, shortly after the FTC proposed the rule in January, it faced legal challenges from businesses, including Ryan LLC and the U.S. Chamber of Commerce, which claimed the agency was overstepping its bounds. In response, Judge Brown called the proposed ban unconstitutional and arbitrary and capricious. Despite the setback, the FTC has indicated that it may appeal the decision. According to spokesperson Victoria Graham, the FTC is weighing its options for a potential appeal and hasn't ruled out pursuing enforcement actions on a case-by-case basis. The non-compete ban would have prevented employers from issuing new non-compete agreements to most employees, with the exception of senior executives earning more than $151,164 per year. Existing non-competes for this group could remain, but no new ones could be created. This development is particularly interesting for the furniture industry, where non-compete agreements have long been used. The industry will be closely watching how this legal battle unfolds, as the outcome could significantly impact hiring practices and employee mobility within the sector. The U.S. existing home market has shown signs of recovery, with a 1.3% increase in sales in July, ending a 4-month slump that began in March. Despite this uptick, sales are still down 2.5% compared to the same period last year. The Northeast, South, and West saw the most significant improvements, while the Midwest remained stable. The median price for existing homes rose by 4.2% from July 2023, reaching $422,600, marking the 13th consecutive month of year-over-year price gains. This underscores ongoing affordability challenges for potential buyers. The Northeast experienced the largest price increase, an 8.3% jump, pushing the median price to $505,100. According to Lawrence Yun, chief economist at the National Association of Realtors, the modest gain in sales reflects sluggish overall performance but more choices and improved affordability due to lower interest rates. Inventory at the end of July increased slightly, offering more choices to buyers, which could help alleviate some pressure on prices. The inventory of unsold existing homes was up 0.8% from June and 19.8% from a year ago, representing a 4-month supply at the current sales pace. The existing home market's regional differences highlight the uneven recovery across the country, influenced by local economic conditions and housing market dynamics. The 30th anniversary of Intertextile Shanghai Home Textiles saw a remarkable 10% increase in attendance, attracting more than 35,000 visitors from 108 countries and regions. Impressively, 13% of these attendees came from outside China, underscoring the event's international appeal. This edition of the biannual trade fair included 946 exhibitors, representing 15 countries and regions, showcasing a vast range of home textile products. Wilmot Shea, general manager of Messy Frankfurt, highlighted the fair's impressive growth from its inception when it featured just 123 exhibitors. Shea emphasized the event's role in catering to both international and domestic visitors and indicated that future editions will continue to evolve with the industry's ever-changing demands. Walmart recently made headlines by selling its stake in JD.com, a major Chinese e-commerce company. The sale raised approximately $3.6 billion for Walmart, and this decision lines up with their broader strategy to focus on other priorities within the country, such as their Sam's Club operations and their hypermarket business. According to reports from sources like Reuters and Bloomberg, JD.com saw a dip in their stock prices following the news, while Walmart experienced a small uptick. Despite ending the 8-year partnership, Walmart emphasized that they will continue to collaborate with JD.com, calling them a precious partner. So what's behind this big move? Walmart's recent State of Adaptive Retail report, published in collaboration with Morning Consult, provides some insight into the evolving retail landscape. The report highlights how consumer behavior is becoming increasingly channel agnostic, blending physical and digital shopping experiences. It turns out shoppers are now more comfortable navigating between online and in-store channels, with categories like apparel leading the way in mixed shopping habits. This trend provides a clue about Walmart's future direction. By selling its stake in JD.com, Walmart can reallocate those funds to enhance their omni-channel retail strategy, particularly in China. They aim to bring more seamless integrations between online and in-store shopping, which aligns with consumer desires for convenience and immediacy, whether they are shopping online or walking into a store. Looking ahead, this infusion of cash opens doors for potential innovations and further expansion. Walmart's focus will likely be on tech-powered solutions that enhance the shopping experience. As early tech adopters and Gen Z continue to set the pace for these innovations, the shifts we're seeing could very well be an indicator of retail trends to come. It'll be interesting to see how Walmart leverages this move to stay ahead in both the physical and digital retail worlds. Bedding brand Purple Innovation is making some big changes to its manufacturing setup. The company has announced plans to consolidate its mattress manufacturing into a single factory located in McDonough, Georgia. As part of this restructuring, 2 facilities in Utah, specifically in Salt Lake City and Grantsville, will be closing their doors. This move is aimed at improving efficiency and boosting market share growth. The new Georgia facility is significantly larger and equipped with the latest production technology, including their new grid technology. Although this change is expected to benefit the company in the long run, it will affect fewer than 300 employees. However, Purple is offering these employees the chance to relocate to Georgia, with their roles and benefits intact, or to receive 100% financial assistance for the move. The company plans to maintain its headquarters in Utah, and will continue its research and development at its Innovation Center in Draper, Utah. They are also retaining their 4 showrooms in the state and will be opening a distribution center in Utah in February that will include light assembly work. CEO Rob DeMartini emphasized that the consolidation is not a defensive move, but rather an offensive strategy to invest more in innovation and marketing. The expected completion date for this restructuring is early 2025, and Purple anticipates seeing significant financial benefits from these changes. By concentrating their manufacturing in a more advanced and larger facility, Purple Innovation is setting itself up for better demand management and enhanced product development, marking a crucial step in their path to premium sleep strategy. Thank you for tuning in to Furniture Industry News. Don't forget to subscribe to our podcast for more updates and insights into the furniture industry.